Tesla CEO Elon Musk. AP photo/Noah Berger, file 1 of, if not the biggest, Tesla bull. Trip Chowdhr at Global Equities Research, significantly cut his March quarter Model 3, S and X deliveries and seems to be questioning the price cuts Tesla made along with closing its stores. It may turn out that the company overestimated demand for its vehicles as initial Model 3 buyers decide to not pull the trigger. Chowdhr is concerned that the price cuts Tesla has made for the Model 3, S and X won't stimulate demand, and that the company's brand could be at risk of being diluted. He wrote that Tesla should enhance the stores for marketing and brand purposes. It appears he believes Tesla stores should be like Apple stores, which serve to not just sell and service products but to also showcase the car's technology. An employee assists a customer with pre-ordering the Tesla Motor Incorporated Model 3. Photographer, Patrick T. Fallon/Bloomberg Copyright 2016 Bloomberg Finance LP Chowdhr makes regular visits to Tesla's Fremont manufacturing factory and its delivery hub where customers receive their car. His pictures and videos show these facilities bustling during the December quarter but are now ghost towns. It appears the company pulled so many sales into the December quarter so customers could receive the $7,500 federal tax credit, that it siphoned off a large portion of March quarter's U.S. demand. Chowdhr is betting on China and European sales to make up for the slack U.S. demand, but the same story could play out of satisfying early adopters and Tesla fan orders. Car Transporter carries Tesla Model 3 new vehicles. Photo credit, Getty shares are under pressure over the past 6 trading days. Tesla's shares have fallen from $319.88 to $284.14, down 11%. Due to Elon Musk announcing the $35,000 Model 3 and closing most of its stores, the shares have also dropped from its December 13, 2018, recent high of $376.79 or almost 25%. Having one of the company's biggest cheerleaders coming out with such a large cut shouldn't be positive for the stock. Tesla 5-year stock price chart. StockCharts.com. Chowdhr halved his Model 3 estimate for the March quarter, cut Model 3 deliveries from 60,000 to 30,000, versus 63,359 in the December quarter, cut Model S and X deliveries from 23,500 to 18,000, versus 27,607 in the December quarter. Assuming an average selling price or ASP of $50,000 for the Model 3 and $90,000 for the Model S and X, Chowdhr decreased his revenue estimate by $2 billion. This makes his revenue projection more than 35% below the street's average and 28% below the lowest forecast, per Yahoo Finance. March quarter financial projections: revenue of $4.0 billion versus average street estimate of $6.3 billion, low street estimate of $5.54 billion, EPS loss of $1.32, versus average street estimate of a loss of $1.58, low street estimate of a loss of $3.35. For Chowdhr's $4 billion revenue to be substantially lower than the street's but his EPS forecast to only be a bit lower should mean he is projecting margins that are stronger than the rest of the analysts. If he is correct in his revenue estimate, it appears that his EPS projection is too high. 2019 financial projections: revenue of $27.2 billion versus Average street estimate of $28.1 billion. Low street estimate of $24.8 billion. EPS of $2.33 versus average street estimate of $5.65. Low street estimate of a loss of $1.50. It is interesting that Chowdhr's 2019 revenue estimate is only a bit lower than the street's, but his EPS projection is much lower. This is the opposite of his March quarter forecasts. 2020 financial projections: revenue of $32.1 billion versus average street estimate of $33.1 billion. Low street estimate of $25.1 billion. EPS of $11.02 versus average street estimate of $9.65. Low street estimate of a loss of $0.65. For 2020, Chowdhr's revenue estimate is a bit below the street's, but his EPS projection is a decent amount higher. His margins have moved back above the street's. Tesla Motors Incorporated CEO Elon Musk speaks at the unveiling of the Model 3. AP photo / Justin Pritchard. Valuation is still steep. To get a feeling for Tesla's stock valuation, one measure would be to compare the company's market cap to revenue ratio. Since the company doesn't generate meaningful profits, at its peak, Tesla's market cap to revenue ratio was 3.1x versus the current 1.9x based on Chowdhr's 2019 revenue estimate. These are market cap to revenue ratios for some of Tesla's competitors using current stock prices and year 2018 revenues. As you can see, Tesla's 1.9x ratio is 3 to 9 times greater than these car companies. Unless Tesla can continue to significantly ramp revenue and generate consistent, meaningful profits, the stock has further downside exposure. Audi, 0.64x BMW, 0.47x Ford, 0.21x GM, 0.36x Honda, 0.34x Toyota, 0.63x